Welcome to Undercover Analyst. Several factors are in place for the return of stagflation in the world's largest economy, and which could accelerate the decline of the dollar. And that's the biggest fear right now with the US market. With other economic issues in the US already taking center stage, what economists are worried about is the ongoing inflation problem, where they deny that the inflation is not transitory, but it will remain sticky, and that is that it is here to stay, and the Fed's rate of 2% is nowhere near. Some say history repeats itself, others say it merely rhymes, but going by the headlines in the recent month, it certainly feels like the US economy is in for some deja vu moments in the coming days, because we have seen this inflation thing way back in 1973. And now what is happening is Saudi Arabia and Russia have both cut crude oil outputs, and the output cut will be extended till the end of the year 2023. So you can see here clearly what it says is that oil production slumps as Saudi Arabia cuts output. The decline is largely a result of Saudi Arabia delivering on its 1 million barrel per day production cut. So if you look at the inflation numbers from the past 2 months, it has started to pick up, and you can see clearly an uptick. So it is currently at 3.7%, which is down from the high of 9%, but the Fed's target inflation rate is 2%. So just when policymakers thought they are closing in on achieving the Fed's inflation target of 2%, there is an uptick on the inflation rate. To understand completely the problem of inflation, considering the current scenario of high crude oil prices, we will have to go back 50 years. So we will have to go back to 1973. In October 1973, members of the Organization of Arab Petroleum Exporting Countries proclaimed an oil embargo on the United States. Now, these are some of the scenes of that time. You can see clear shortage of oil and gas, pumps closed all over the United States, and this led to the price increase in crude oil due to shortage. So let's try to understand what really happened here and what is an embargo which was placed on the United States. Well, an embargo is an economic situation wherein entities engage in an embargo to limit the transport of petroleum from an area in order to exact some desired outcome. So that's an official definition of what an embargo is. So in short, an official ban on trade or other commercial activity into a particular country, that's called embargo. So why was this embargo placed in 1973? And that's what we want to understand here. Why did the Arab petroleum companies actually place an embargo at the first place? And the embargo was actually in response to America's support for Israel during the Yom Kippur War. Now, what is that? The Arab coalition jointly launched a surprise attack against Israel on the Jewish holy day of Yom Kippur. Now, that's called the Yom Kippur War. And the Arab coalition party attacked Israel, and the surprise thing was the US supported Israel with arms and other supplements for the war. So, what happened in response to the US support to Israel? The Arab members of the OPEC, which was led by King Faisal of Saudi Arabia, decided to reduce oil production by 5% per month on October 17. And on October 19, President Nixon authorized a major allocation of arms supplies and a $2.2 billion for Israel. Now, this created a sort of problem in Saudi Arabia, and Saudi Arabia declared an embargo against the United States in response, and it was later joined by other exporters as well. Now, what they actually did was completely stop the oil supply to United States in response, because they were not happy with the US supporting the Israel. And that is how the 1973 energy crisis happened. The 1973 crisis went on up till March of 1974, and what happened actually was, in the aftermath, crude oil prices quadrupled from $3 per barrel to nearly $12 per barrel globally. The embargo actually triggered one of the most devastating periods of inflation in the American history. This period would come to be known as the Great Inflation of the 1970s. US CPI doubled in 1973 to 6.2% and rose again to 11% in 1974 before moderating to 9.1% the following year. It again rose sharply towards the end of the decade, hitting a peak of 13.5% in 1980. So the embargo actually created a huge inflation problem for the United States for the rest of the decade, starting 1973. So what's similar and why are we talking about the 1973 scenario? Now, when we come back to the present day, we can see many similarities in the inflation scenario that the US find itself in today. For example, last year saw retail inflation in the US hit a 40-year high of 9.1%. Subsequently, it declined slowly to 3% by June this year, leading to sighs of relief in both policy circles and stock markets. However, since June, we can see there's a uptick in the inflation, and it's now up to 3.7% by the end of August. So what's really fueling the inflation right now? And the answer is the higher crude oil prices. With no strategic oil reserves to counter the production cut, which is being placed by Saudi Arabia and Russia, the crude oil prices have risen steadily from $70 a barrel to now up to $93 a barrel. And that has become a problem which is very similar to the 1973 inflation problem. While there is no oil embargo by Middle Eastern countries this time, this up move in crude oil is being driven by production cuts, jointly by Saudi Arabia and Russia. And the motivation this time is profit. The motivation in 1973 was it was an outrage over the Yom Kippur War, but the impact may be just as devastating for the US and global economy even this time. The current bout of inflation, which began in 2021, is yet to let up, was initially dismissed as transitory by the US central bank. So they said, no, this is for the short term. The current inflation, which began in 2021, which is now seems to be a little bit under control, was initially dismissed as transitory, which means it is there for some time, but in the coming quarters it might cool off and it would come to the Fed's target of 2%. But what's happening is what we see now is that the inflation is actually sticky and not transitory. Sticky means it's going to stay there for some time now. As late of August 2021, yields on the 2-year Treasury bond of the US government was just 0.2%. But what has happened to the yield now? The yield is now more than 4.795%, as you can see here. Now, the yield is a reflection of what the market expects the average interest rate to be. So in 2020, when it was just 0.2, the markets expected the interest rate to be lower. But now what the markets are saying is that the interest rate will be even higher from the current levels. And it keeps on increasing, which says it might go up to 5, it might go up to 6. And that shows that the general market is actually expecting a rate hike, another rate hike by the US Fed. It has become very clear that the inflation is not transitory. And the US Fed has also started to increase the interest rate aggressively. And we saw that in November 2022. All the efforts by the Fed was not a waste because we saw it started falling in March this year on hopes that the inflation has been successfully tamed and the Fed would start cutting interest rates by the end of this year. However, since May, it has become more and more clear that the inflation is stickier than expected, and you cannot just deny it by saying that it is transitory. And with this, hopes of a rate cut anytime soon is not looking possible. This has been reflected in the renewed upsurge in bond yields, which have now hit 5.13% as we speak, which is similar to the peak hit during the global financial crisis 15 years ago. So things are not showing up good shape. Things are not showing up in good shape in the US. The inflation is high, the interest rate is already high, there's no room for a rate cut, and the bond yields are at a 15-year high. So Saudi Arabia has and Russia's oil cut has actually fueling the problem even further because the crude oil is now like $95. Now, how all this started? Well, the low interest rate has a big problem on the economy. More long-term cause is often ignored by the economists. The ultra loose monetary policy followed by the US central bank since the recession of 2008 and 2009, this has been the major reason for excess of money supply, which in turn has fueled inflation. Interest rates were kept near zero, where trillions of dollars were injected in the economy via quantitative easing. That's a very dangerous word. This influx of easy money into the system laid the groundwork for an eventual surge in inflation. Consumer prices remained relatively stable in the decade following the Great Recession. It wasn't until the COVID-19 pandemic struck in 2020 that inflation pressures truly started to mount. In response to the economic lockdowns, which was enacted due to the COVID-19, the Fed again cranked up the money printing presses. Congress also approved trillions in fiscal stimulus and relief spending. While these measures averted a worse economic crisis, they added fuel to the inflation fire. Still, the Fed initially maintained that the pricing pressure would be transitory. The thesis was that inflation would abate one pandemic induced supply chain problems. But the things are not looking like that now. And then happened Russia's invasion of Ukraine, and this brought home the seriousness of the situation of the central bank officials. Energy and food commodity prices soared, and with the invasion, and it disrupted the vital supply chains. Being one of the world's largest oil and natural gas exporters, Russia supply around 10% of the global oil output, and it also is the top natural gas exporter, which is like about 20% of the global supply of natural gas. Now, sanctioning limits to these exports, self imposed cuts by Russia, and all these stuff have now uh, brought us to a situation where the crude oil prices are going north and is becoming a big problem. So, crude oil prices we have seen around $90 a barrel in February, spiked to over $120 in the aftermath of the invasion. But it eventually cooled down. But what is happening is now it's going north again. And this time it's due to the production cut. The other important point is that Russia and Ukraine are vital suppliers of agricultural commodities. So once they are involved in a war, uh, the 30% of wheat global exports and 20% of corn exports comes from these countries, and that's why there is a grain shortage. Now, what happens when there is a supply side shortage? The grain prices start to go up, and which is adding insult to injury to the ongoing inflation. Now, let's talk about the dollar. What happens to the dollar when we have such a high inflation era? The decline in the dollar is actually driven by years of quantitative easing that have stoked worries about currency debasement. If high inflation comes back to haunt the United States economy, there'll be serious concerns about dollar dominance, which is already growing faint now. Countries such as India, China, South Africa, and Russia have started trading with each other without using the dollar. And this is where the dollar dominance has come under threat. Going by history, reserve currencies have a life of around a century before fiscal abuse leads to dethroning of that currency. The pound sterling was from the mid 1800s up to 1900 was the dominant currency in the world. When World War I drained the British finances, the next currency which took over the world was the dollar. The dollar is now dominant currency since 1925, and it's almost like about 100 years. With deficit at post-war highs and inflation like the 1973 scenario, the dollar could be nearing at the end of its lifespan as a global reserve. I know it's a big thing to say that, but the downfall has already started to be seen. Meanwhile, the US policymakers should worry about is that prolonged inflation would accelerate the erosion of dollar dominance, and that monetary policy alone will not be able to tame inflation. And they're all efforts of averting a stagflation might not work now. To retain economic preeminence, America must get its fiscal house in order and reduce its yearly fiscal deficit, which is around 5.3% of GDP, and they have to bring that down considerably to stand a chance, or what the economists call as soft landing. And right now, the conditions are not looking like a soft landing. So, will this inflation and high interest rate will crash the U.S. economy, and in turn the world economy? That we always know that when the US goes down, the world it takes the world along with it. It has been seen many times in history. But to see all this, we'll have to wait and watch. Right now, the scenario looks bad. If you like this video, please share, subscribe,